Are you buying a house in 2024 and you have student loans? Today we're going to be breaking down what does that mean when you have student loans and you are buying a house. I have my buddy Tyler in, who's a local lender, and we'll be going through these numbers better to help you understand and to help me understand too.
All right, yeah, so when you're buying a house with student loans, the obvious effect that student loans have is debt to income ratio. It's gonna affect your, just like, if you had a car payment or if you had credit card payments, it's gonna be on your credit report. It's gonna show you have certain payments. Now, sometimes student loans are in deferment, so it'll show no payment. And sometimes they do have a payment plugged in if you're actively paying on your student loans. The kind of key thing to know about student loans is if they're in deferment, as a lender, I still have to count a payment. And if you have a conventional mortgage, it's going to hit you a little harder than if you have, let's say, a FHA mortgage. So that's something that kind of as a lender, I'm going to go through and for many different reasons, figure out which loan best works for you. But that could be a key factor is, hey, maybe you can qualify for more if we go FHA because your student loans will affect you less.
Now, if they're in deferment and there's no active payments on it, how do you know what the minimum payment will be?
So the way that it works,
because everything goes off a minimum payment, right?
Yes.
If you have a credit card, even though it's way up there, it's going to go off a minimum payment that's due. So what about student loans?
No, it's a good question. So the way it works is you take, on a conventional loan, you'll take 1% of the balance as a monthly payment. But on an FHA, we'll take 0.5%. So it hits you half as hard.
So that's a big difference.
Yeah, so it's a big difference. So a lot of times, if you have a lot of student loans, that's another reason why FHA is probably a little bit better. Also, FHA in general just allows for more DTI.
Well, let's break down the 1%. So let's say we have $100,000 in student loan. So that would break down to $1,000.
$1,000.
And then that would be the monthly minimum payment.
So that'd be, yeah, and basically the way it works with a lot of people is you'll notice in your credit, it has like a bunch of different accounts. It'll say like a handful of different accounts. So I'll be adding that 1% to every single one of them. And then by the time it's all added up, it can be it can really affect a DTI. So another important factor with student loans and job history that comes up a lot is, hey, I just got out of school and I just started my job, but I need 2 years of job history. Is this going to impact me? The good news is for almost all loan types, I believe all loan types, your college time counts towards your employment.
Even like the trades.
Yes, yeah, trades as well.
Trades as well. So that does count towards your work history.
But it's important to know because a lot of people might think like, oh man, I got to be at my job for 2 years to qualify for a house. It's not true. If you have a solid job, employment letter, your first pay stub, it's a W-2 job, it counts. All that employment counts.
Now, from a job aspect, and this might be getting in the weeds and overthinking the whole thing, but from a job aspect, if I go from, say, like a commission base to salary or whatever, that's fine. But vice versa, salary to commission, that would be a big red flag, even though I have that job history. Yeah. Can your college education say, my wife's an engineer, she went to school for being an engineer, whatever, and then she gets a job that's not engineer related, does that still count as work history?
Yeah, so
they have to go hand in hand?
It's definitely in the weeds, and it's definitely like a case-by-case basis, but it's a good question because sometimes if you're changing employment drastically and it's like an entirely new situation, let's say you went to school to be like a scientist, but then you're getting like a job in something entirely different. Some underwriters can have an impact on that. Like, if you're saying, hey, I'm getting a job in, I don't know, computer engineering, but my degree's in basket weaving, like there could be a situation where, some underwriters might question that and go, hey, but by and large, most of the time, if you have a degree and that school time counts towards that trade or that profession,
okay,
you're probably fine. But no, so that's a good point. So the job history is important because that's a key question I get a lot is, hey, I just left college, I had this job, been here for 2 months, but I need 2 years of history. Can I still get a loan? Yes, especially if you have a degree in computer science and you're working as a cybersecurity engineer. So it's very one-to-one. That does count towards your job history. But so a couple different methods for student loans is one, if you're already making payments on it and you have a certain payment plan set up, we can use your payment plan paperwork. And then a really popular option that I always talk to people about is the income-driven repayment plan. Very popular. I've never done one myself, but I've seen them done a lot where, basically based on your income and some of the calculations, it gives you kind kind of wraps up all your student loans into one payment. And if I have that paperwork, I can use that payment as opposed to having to plug in 0.5% for every loan or 1% for every loan, which got like crazy.
Okay, that's a huge
difference. So
now, is that an actual refinance of all these loans, or is that like some sort of government program?
I believe the way it works is it's a government program, and I think it's almost like a debt consolidation type of situation where, like, you're kind of rolling it all into one payment, and it might take longer, but based on your income, they agree on this set amount, and then that counts for.
Now, will that change as your income goes up?
I believe it does. I don't know how often they come back and recalculate all those kind of details, but I think if you did make a bunch more money in the future, I'm sure it readjust upwards or down, but there might be that's something we could research in the future. But I think there's probably like a time frame they go back and say, hey, you're making 100 grand more. You might have to pay more.
You should probably pay more.
Yeah, probably. But what's great is you can go from owing, if I calculated it could be $1,000 a month to $100 a month or $50 a month, and your DTI is way freed up. You can afford way more of a home. So it's definitely a huge option. Something you could explore prior to even getting pre-approved. I think you can even reach out to them and get it like an offer almost. They'll say, hey, here's what we offer you for your plan. You don't have to take it right away. You can just see what you might pay on it. But yeah, it's a huge option.
And that's good because, honestly, student loans are no joke.
Yeah. I've seen some hefty student loans out there, and for good reason. A lot of people have some pretty great.
You can't just file bankruptcy. They're there.
They're there, and they're very difficult to go away.
It's crazy. The 18-year-old kids are going to college, and then they can just sign up for that amount of debt.
A lot of debt. Now, granted, I would say a lot of people, it's pretty manageable. It's not too much, but I've seen some pretty hefty amounts out there where it's like, man, you got, $100,000, $150,000.
What's the biggest student loan you've ever seen? Obviously, without talking about clients or anything.
Yeah. No personal information or anything. But I think in totality, if you added up all their student loans, I think it was nearing 200.
Nearing
200,000. So yeah, there's some heavy student loan debt out there. And granted, they might have a master's degree, or maybe they have but it's gonna take you quite a bit to pay back those student loans. And but what good news is there is ways to mitigate how much that's affecting you qualifying for a home.
Yeah.
Whether it be doing the government loan program, whether it be doing an IDR, there's ways around it.
So first-time home buyers, that's where FHA is going to be a really good factor because it'll help with that debt to income. Because ultimately, everything kind of comes down to the debt to income. You could be making $1 million a year, but if you have debt out the wazoo, it doesn't really matter.
And trust me,
you've had people.
I've seen it where I've had clients that make 30 grand a month that
30 grand a month.
They don't qualify for as much as someone making 5 grand a month.
Yeah, that's insane.
Because it all comes down to how much money
lifestyle
is tied up. Yeah, do you have a lot of, are you paying for a jet ski and a boat and a car? And, if you have all these monthly payments going out, it's going to affect how much you can qualify for a home. So yeah, that all plays into it. But what's good is, you can definitely mitigate a lot of the student loan affecting how much you're qualifying for in many different ways. There's creative ways to go through it, which is why it's good to have a professional help you out and talk you through, hey, how can we mitigate these down to where it's not affecting you as much?
Absolutely. Yeah. Well, guys, I don't think student debt is going anywhere anytime soon. So that's why we wanted to do a video on this. Of course, if you ever really want some serious help, Tyler's licensed quite a few states, but here in Virginia, you can chat with him at any point and he can kind of walk you through this. It's going to be case by case for the most part. Everybody's scenario is going to be different, just like almost every transaction is a little bit different. So, I would highly recommend you guys reach out to Tyler, talk to him about your scenario, and he can give you the steps to get you that house.
Absolutely.
Yeah.
Appreciate it, guys.
All right, guys. See you on the next one.